If you want to invest in gold, you need to analyze the price of gold. What affects the price of gold and where should we start? Let me tell you, everyone. This is Brown's Wealth Management Watchtower. I am committed to building a visionary watchtower for you so that you can identify the direction and move forward steadily in a complex and changing investment environment. In the long run, gold can serve as a hedge against inflation and maintain its value. As a safe haven asset, it also shows a negative correlation with stocks. In the short to medium term, although the price of gold can also show some signs of hedging and preservation, it is almost completely submerged in people's indescribable love for gold and the soaring speculative demand for personal finance. Let's analyze what affects the gold price. I want to analyze the gold price. Where should I start? Actually, it does not generate any cash flow and has no valuation, so your main analysis is supply and demand. There is a very imprecise summary on the supply side. As we just said, it is very stable. Secondly, it has been very stable in history, so it can be ignored. That's all for jewelry and investment. Actually, if you think about it carefully, there is a very interesting correlation between these two needs. The negative correlation between them is very strong, forming a very wonderful balance. Generally, when the economy is good, people have money, right? With enough confidence, they tend to buy jewelry and watches. At the same time, the demand for investing in gold may be relatively weak at this time. More people may buy stocks, houses, or start businesses. On the other hand, during economic downturns, people may not buy gold jewelry, but you need to hedge and preserve your value, so the demand for investing in gold comes up. When the pandemic first arrived in 2020, it was very evident that the demand for jewelry immediately fell, but the demand for investment surged. At that time, the main growth point was the gold ETF, so theoretically, these two demands offset each other, which helps stabilize the gold price. However, in reality, although the trading volume of physical gold does not fluctuate greatly, the fluctuation of gold price is very intense. The main driving force is the investment demand in the demand we just mentioned. Let's first further break down the investment demand. Why do we invest in gold? In fact, there are only a few reasons. Firstly, to resist inflation is to resist inflation of any currency. Do central banks of various countries buy gold because they like it? Not all countries are crazy about borrowing and printing money. What should I do if I am not at ease? Buying some gold is very intuitive. Therefore, the manifestation of gold's resistance to inflation is that its price is negatively correlated with the US dollar index. Simply put, if the US dollar rises, gold will fall, and if the US dollar falls, gold will rise. Another demand is hedging. Speaking of hedging does not necessarily mean that a crisis has arrived. This danger can be war or crisis, but it can also be a very vague concern. For example, if you want to say, I have money now, what should I invest in? Buying a house may be a bit risky, and buying stocks may not be appropriate at this point. You feel like buying this or that is not feasible. So, what should I do? Buy some gold bars. In the long run, this gold will not lose. This behavior, this idea, is actually the manifestation of gold prices in the form of demand conversion, that is, it is roughly negatively correlated with other assets. If other assets fall, gold will rise. For example, if you look at this gold in the United States, the prices of stocks are generally negatively correlated, and you can see that the two investment needs of anti-inflation and hedging are actually very intuitive. It can be said to be imprinted in our bones. Have you ever thought about these two demands? Does gold really play a role in anti-inflation and hedging? Let me answer directly. It does play a role, but it has a very, very large time scale to play this role. This is also a special point of gold price fluctuation, that is, its cycle is very long. Looking at the overall trend from the 1970s to the present half-century, the gold price has indeed been rising and has basically kept up with the level of rising prices. However, its fluctuations during this period are quite large. For example, from 1980 to 2001, gold continued to fall by 70% for a whole 20 years. If you were unlucky enough to buy gold during the peak of the crisis in 1980, you would feel so uncomfortable. At that time, when it fell to the later stage, many people in the market pessimistically believed that gold might continue to fall like this. Of course, I did choose the most sustained period of decline here, but just look at the trend of this gold price. It rose for 10 years and fell for 20 years. It has risen for 11 years, fallen for 4 years, and risen again for 4 years. The range of its fluctuations is actually very long, so if you buy gold to resist inflation, then your time period needs to be extended to more than 15 years for it to most likely take effect. The relationship between gold prices and inflation within 3 to 5 years can be said to be negligible, which means that its anti-inflation properties are almost completely ineffective in the short term. For example, when you look at the correlation between gold and stocks, if you look at the analysis chart, it is indeed very clear that there is a trend of fluctuation in the long run. However, this is a 50-year time scale. If you randomly pull out a 5-year period from the middle, there will be a positive correlation and a negative correlation, and no obvious trend can be seen. Why do you think this is? Why does the gold price only show its attributes in such a long time scale? Its hedging effect is because its price fluctuates very much. The reason why it has such a large price is because when investing in gold, there are actually two hidden demands. These two demands can be said to be the key factors that affect the gold price in the short and medium term. The first hidden demand is the key factor that affects the gold price in the short and medium term. The demand for gold is everyone's love for it, whether it is due to historical reasons, social environment, or family inheritance, or simply because gold looks good. In any case, people have developed a preference for gold that is difficult to express. I like to keep gold bars at home, and I am willing to keep them without making any money. Many financial analysts call people who have a special love for gold beetles, but personally I feel that this term is a bit misleading. You may feel that only a small group of people are enthusiastic about investing in gold. I think most people have some kind of love for gold in their hearts, just whether it has been stimulated or not. That's why this love can cause such a strong fluctuation in gold prices. It's because it has huge potential to be stimulated, in other words, it has a mass base. You can say stocks. Some people may think that this thing has risks, so I avoid it. But gold, almost no one dislikes it. Its fluctuations may not be that big, but sometimes conversion can lead to fluctuations in gold prices. It's precisely because of this. The general public is the main investor in gold. In stock market terms, there are many retail investors in the gold investment market, which leads to a second hidden demand for gold. Speculative and opportunistic, many people hope to make profits in the short term by buying and selling gold. Let me tell you, this demand should not be underestimated. Many people do not usually think about investing in gold. When the gold price skyrockets, they remember that they need to resist inflation and go buy gold. Are you really resisting inflation risks? In fact, they are heading toward speculation, hoping that the gold price can continue to rise. I said there is no problem with this speculative demand itself, but in a speculative market dominated by retail investors, it generally has a very significant characteristic. Do you know what it is? It is chasing after the rise and killing the fall. When it rises, I also rush in to buy, and when it falls, I rush to run, especially in the rising cycle. Therefore, you can see that the performance of gold prices is often fast rising and slow falling, which is reflected in higher volatility in gold prices. In short, the hidden demands of love and speculation have led to unpredictable price fluctuations in gold prices, which is called noise gold and investment. Although many people consider it a valuable asset, its annualized volatility over the past 50 years has been about 20%, meaning that it has been rising or falling by an average of 20% per year. As a stable investment, the risk is even higher than that of the US stock market. That's all for this issue. If you have any questions, you can communicate in the comment section. If you are struggling with investment and financial management in your daily life, you can follow me with your fingers and give you different perspectives to plan your investment and financial management, making your life more comfortable. See you in the next issue.